Welcome to the Internet Capital Markets podcast with myself, Sarthak, and Aditya Shetty, who is my friend and guide, helping me through everything blockchain and crypto that I don't already understand. Also, our guest today is Neeraj Singh, who's building Xaults. So it's very interesting to have someone who's actually building something in India, who has also been working with the regulators and is working in tokenization of assets in finance on the blockchain. So let's all welcome Neeraj. Thank you for making the time and would love to understand what are you really doing with Zolts. Of what I have understood a little bit is you're solving for trade finance, which is invoice discounting, something like factoring, but it'll be great to know from you.
Thank you so much, Sarthak and Aditya, for having me here. It's a pleasure talking to both of you. So basically, the vision that we started with in Xaults was we were seeing that as economies, we are moving more and more towards tokenization. We are seeing the movement of all the assets towards tokenization, everything of value, specifically in the areas of finance, be it money. We are already seeing the evolution of stable coins, deposit tokens, CBDCs by central banks. Then on the real world asset side, we are already seeing some of the regulators going very much into tokenization of the capital markets. We are also seeing a similar kind of uptake in the real estate space as well. But what we are also seeing is that the financial systems that we have, right? These financial systems, they do not speak to these new age assets, and there has to be an interoperability layer between these two, so that the financial institutions can start leveraging these assets and create new kind of financial products that are going to unlock a lot of value, right? By asset tokenization, what we can do is we can bring in more liquidity, open up the asset class for a lot more people who were earlier not able to get into because of the high price barriers, right? And it brings a lot of transparency and overall operational efficiency as well. So with that vision, we started building that interoperability layer, and with that tech built, we started looking out for different use cases where we can leverage this technology and build new kind of use cases. And supply chain financing was the first use case that we started working on. Essentially, what we are trying to solve is access to formal credit for the SMEs, right? And these SMEs that I'm talking about are typically part of a large supply chain, but they are not selling directly to the OEMs or the anchors, as we call them, right? These anchors could be Tatas, Mahindras. What we see is that traditionally only the direct vendors of these OEMs get financing. Beyond that tier one vendor, there is no formal financing that happens. These guys, these SMEs they are left unserved by the formal banks. The only option that they have is they go to private lenders where the interest rates are typically very high. And when we were discussing this problem with the banks were very much comfortable lending against only the payables of the OEM. Right? So we said, if we break this payable down, make it an asset class, and make it available to every SME in the supply chain, would you be willing to finance? And the answer was yes. Right. So what we did is we tokenized the payables of the anchor, made it a tradable asset class, disbursed it in the entire supply chain, and the banks can just purchase these assets from these SMEs at a discount, and the recollection or the repayment comes from the anchor because these are anchor backed assets, right? So this was the first problem statement that we worked on. We took this to RBI. We just completed the RBI regulatory sandbox. We did it with the banking partners that we had. We had HDFC, ICICI, Yes Bank, and we are also partnered with IBDIC. So IBDIC is Indian Bank's digital infrastructure company. It's a consortium of top 18 Indian banks. These 18 banks control 90% of the Indian banking, and they are kind of solution partners with us on this, and through them, the distribution is also happening. So that's one of the examples, on how we are leveraging our technology to kind of take this traditional invoice financing model, plug in the new generation of assets, and make it accessible to a larger audience. There are other use cases as well, but I'll pause here before we move to other use cases. Yeah.
I think I have a bunch of questions here, which is you took examples of, say, OEMs like Tata, Mahindra, and the like, and especially even in manufacturing in India, we see a lot of these auto manufacturers being a big chunk contributing to manufacturing for almost 2 decades now, right? And especially where I am in Gurgaon, the entire Manesar, then there's a lot of places in Pune, Chennai, where a lot of these auto part manufacturing suppliers actually started. And now what has also happened is that the OEMs are financing their vendors because they do realize that a lot of them have inventory troubles or issues with securing capital, and a number of times because they also know they're kind of pushing them to lower their margins. What they do is they say you can come to us and we offer us a discount and we're ready to kind of give you the payment as an advance, or instead of making the payment in 30 days we'll kind of make it in 5 days or 10 days if you give us a discount for early payment, which is one way of invoice financing. The second way is they would go to a bank, and the bank would then, not too many banks are into invoice financing already. They would have their own thresholds with respect to what is the scale of the vendor, what is the scale of their, available audited financials also to be able to evaluate them, and then whether they even do invoice discounting and say for a customer of a Tata or a Mahindra. Or we're really talking about Tata, Mahindra, Maruti is big players, but it doesn't really exist for smaller players yet. So, given that this is already there, for the OEMs that you mentioned, my question is, have you solved access in terms of to people to whom banks were not funding? Or have you brought in efficiency in cost of financing? That's first, and then after you answer this, I've got certain more layers because I'm still trying to understand the value proposition.
Right. No, I mean, what you mentioned is true, but it's partially true. What we're trying to solve for is both access to credit for the SMEs who are not being served by the banks, and second, also can we overall improve the efficiency of the entire system. If we dig a little deeper, right? So in India, there are only four supply chain financing structures which are available, or rather for the invoice financing. It's either factoring, reverse factoring, SID, or PID. There is no structure beyond these four. It doesn't matter which instrument you choose, right? But as a lender, you will assess the credibility of your borrower, and that's where all these model fails when they go to tier two. Tier two, as in an indirect vendor of the OEM, right? When the bank is trying to assess the credibility of tier 2, the tier 2 doesn't have that. Neither the buyer has it. Tier 1. Tier 1 gets credit because buyer, which is Tata Motors, has a good credibility. But in case of tier 2 and beyond, there is no credibility that the bank can establish, so the bank is not serving those customers. What you talked about, the OEMs financing, their entire chain. There are only, as far as I know, I think only two OEMs in the country. They have visibility of their end-to-end supply chain, especially in auto. While auto is more controlled, the rest of the supply chains are, not even or as organized as auto. And it's largely because the vendors do not want to expose whom they are buying from and what are their margins. Specifically, the reasons that you told, that if the OEM has complete visibility of the supply chain, the OEM starts squeezing hands on the margins of every player, which the
Correct.
vendors do not want. So, based on all this, what we solved was, can we still push the credibility of the OEM to these SMEs without exposing the relationships or the margins? Right? That is the problem to solve, so that the bank, even without doing a credit assessment of these SMEs, can give them financing, because credit assessment criteria these SMEs will never qualify for. Right? So we created an asset class which is backed by anchors payable. So let's say I'm Maruti. I have ₹100 payable to my vendor. Let's say Sona Motors, right? That ₹100, as soon as Maruti says, okay, I am approving this invoice, that means I have received the goods in good condition. I will pay for this in whatever my payment terms are: 45 days, 90 days, 180 days. Uh, the platform based on that approval will create a security, right? In finance terms, you can call it security, but underlying we use blockchain and tokenization. So if it was a ₹100 invoice, we will generate 100 securities. These 100 security fundamentally means that on the due date of the invoice, each security will be ₹1, right? And the payment will come from Maruti because Maruti has said yes to this invoice. Now these 100 securities are then distributed. First, it is offered to tier one, the direct vendor, right? The tier one vendor typically takes 40, 50, in some cases even 60% of the financing, right? So tier one will go to the bank and say, okay, these are 50 securities from, Maruti, give me financing on top of this. So the bank will purchase those security, deduct the upfront discount, give him money. The rest 50 securities that are available with tier 1, now it can pass on to tier 2 as an asset class. And this is where the differentiation between our models and other models is there. This is a new model that we are introducing in India. This model is not there. When tier 1 is passing these 50 securities to tier 2, tier 1 is basically doing two things. One, it is it is also making a payment, right? If there was an, because 50 securities will be 50 rupees. So it's making a early payment to tier 2 saying this will become 50 rupees. Here is my payment. If there is an upfront discount, the tier 1 will also take it. Invoice will be adjusted. So if it was a 60 rupee invoice between tier 1 tier 2, the outstanding is only 10, let's say. Second thing that tier 2 is doing is enabling tier 2 to get access to formal financing using these securities, right? So when tier 2 has these 50 securities and it goes to the bank and say, hey, I have Maruti securities. For the bank, the risk remains the same, right? The risk is still on Maruti, but my borrower is now tier 2, which I can just do a KYC, KYB, and a very shallow assessment of maybe GST returns or something, which also if the bank doesn't do, it doesn't matter because the repayment is going to come from Maruti. The bank again purchases the security at a discount, gives them money, and includes them in the formal financial ecosystem. So systematically it can solve. And over the time, because everyone's invoices are coming to the platform, everyone's GST filings are there, we can see how the repayments are happening, the turnovers, we can start building their credit scores because we have relied as an industry. I've seen at least, we are trying to solve this problem for last 10 years, but no one has been able to solve this because there is no alternate data using which you can solve it. The data has to be built from the foundation, and that's what we are trying to do. So over the period of time we will start building credit profiles for these SMEs, and then these SMEs can start becoming the anchors and we can penetrate to even greater depths. So that's
Wow, okay. So I'm just what I would say most intimidated by in this entire business model is the fact that you've turned any such receivable or payable into a security. Because I would think whenever we think about turning something into a security, essentially SEBI comes in, and
yeah.
it is covered and regulated by SEBI, and they have to. I mean, even for something like REITs, right? Like when real estate got tokenized, um, there is an entire framework, and even though it has been in India for almost 5 years, if I'm not mistaken, it is still evolving where they've come up with SM REITs and stuff, which is why you also see a lot of companies who started doing fractional real estate also go down under, and some of them, being picked up by SEBI to say that they were not really working in the best interest of the investors.
Right,
So
right.
now my next question is that when did you really start building it, and how have you gotten the regulator to approve it? And if you've turned it into a security, is this as a security also available for retail investors to kind of chip in with, or it's in a closed ecosystem where only say the OEM will acknowledge this security and retail investors will not? How does that regulatory angle work?
So first, how did we get to RBI, right? So even before going to RBI, we were partnered with this banking consortium, and then we also onboarded these banks, and jointly we went to RBI because as a startup, if we go to RBI and say, this is what we want to do, the response might have taken long. I would not say that the RBI would have, kind of discarded it. Right now, RBI is all interested in listening to whatever ideas you want to propose to them, especially the fintech department, right? But having those banks and the consortium kind of gave us a lot more credit, gave the idea a lot more credibility, right? And RBI also saw merit in solving the problem, using this framework. And we asked for certain relaxations because you only go to RBI sandbox if you want some relaxation in the existing regulations, or you want a completely new regulation, right? If the regulations are already there, you don't really go to the regulator in the regulatory sandbox. So we went and we asked for the relaxation that we want to create this new asset class on invoices, and these should be tradable. Um, Whether they will be tradable only in the closed ecosystem or they will have a value outside the ecosystem, I think that once the final regulations from the RBI comes, we will get to know. But my sense is that it will remain in the closed ecosystem. Whoever is the participant of that ecosystem, will be able to get some value out of it. Whether retail participation will be enabled or not, we want that. We are also kind of propose it to RBI that why don't we create a marketplace where everyone can come and start investing in these asset classes, because ultimately they are backed by a large anchor, right? And it's a short term kind of investment, and you can get good returns. So why not open it up? And if we are already breaking it down to 1 rupee, right? A retail investor can come and and participate. So why not open it up for them as well? Uh, but I think because this is something new, it will be a step-by-step approach that the regulator will take. Regulator is very cautious about protecting, the consumers. So maybe it will first only be open for the lenders, and then maybe over some time, it might get accessible to retail investors as well.
So I think that explains it well. My next question, of course, Aditya, I would want you to come in at the point where we dive into the blockchain. There's some basic questions that I'm still trying to understand about the business model is what is the cost of financing for the small second tier supplier to the OEM? That's one. And the second would be what percentage then translates to your fee? Is it something that the bank pays you for having enabled the platform, or is there also something like a subscription fee or a fixed fee that you charge from customers to be listed on the platform and enable this for them?
Right. So right now, the kind of fee that tier two and beyond, pay is upwards of 18%. Right. I would say 18% is for slightly mature SMEs, but if you're not doing turnovers of around 100 crores, your fee might be even 24%, beyond. Uh, but because in our model, these SMEs have access to the same asset class on which the bank was financing at 8 to 10%, typically the financing can happen at that rate. But there is a sort of there is an incremental risk that the bank is taking going from one tier to another tier, right? With every tier, there is an incremental risk. So the bank also increases the rate a bit. How much that increment is going to be, that I think once we are commercially live, we will be able to get those answers. That how much is that increment? But my sense is it shouldn't be more than 1-2%. But it's up to the lenders to decide what should be that incremental rate.
Okay. And then the banks would be sharing a certain percentage of their earnings.
Yes,
You
yes,
so
yes.
you
Commission.
will earn primarily from the banks.
Yes, yes. There is
Okay.
no
And
fee for the
there is no fee for the
yes,
vendors.
yes. Yes.
Okay. So and you mentioned that you're going to get into commercial licensing, or there is going to be a commercial rollout. So what all do you think is pending for that to happen?
So RBI approval is pending. We finished the sandbox testing in May this year. RBI usually takes couple of months to give a formal go ahead that the solution can be used by financial institutions. So once that is out, we should be able to commercially launch this.
Sure.
Yeah, I had one question on the data structure and the value flow as a third party to banks and vendors, right? So I'm assuming there's a reason why the banks couldn't do this themselves, right? Because they would have to go and issue tokenized versions of the invoice, make it readable across their systems, make it work with other banks maybe, and it's not something one bank can do. So have you built this within Xaults as a product? Is there a private blockchain that you're using for this, or is it just your database? I'm just curious on, as a third, or is this going to get linked into into an account aggregator like framework on the commercial side of things? Like, what is the infra setup there, and how do banks think about it in terms of data ownership and access to data of this information? Because in theory, some NBFC could also start competing for these securities in the future, right? If it is depending on how open the data ecosystem is.
Right. So we wanted to keep the ecosystem as open as possible so that we can see more participation from everyone, from the banks, from NBFC, even SMEs coming to us directly. Uh, that's why we used a permissioned blockchain. The blockchain is developed by us. We developed our own private permission blockchain, and it's an application specific blockchain that is built just to do supply chain financing. It is not built for any other kind of application that the blockchain will support. And we did this, primarily for two reasons. One is for efficiency, because if you build a general purpose blockchain somewhere, you are, losing efficiency and the scalability part. Second, we also wanted to keep everything at the protocol level rather than building an application and using the blockchain just as a data dump. And so the entire business flow is developed as protocol of the blockchain itself, right? So this gives a lot more security than a general purpose blockchain, and having applications running on top. On the data structure, as you rightly mentioned, because it had to be shared to multiple parties, which could be multiple banks, multiple SMEs, and no one wants to share their private data with other players or other competitors. We had to kind of build some sort of pseudo anonymity within the system. So we separated the sensitive data and the pseudo anonymous data. So all the sensitive data remains off chain, which is managed by the bank. So only they have access to it. They can only resolve it to the actual names and contact details. While the pseudo-anonymous data remains on the permission blockchains, similar to Ethereum, right? Everyone can see what's happening, but they cannot resolve it back to who's doing what. We want to take it a step further, where we start introducing the zero knowledge proofs, so that even that data we can, the pseudo anonymous data that we have, we can make it completely anonymous, because even with pseudo anonymous data you can still do some sort of tracing, right? So next would be that we are already working on that. Yeah.
And so in this case, are banks then running nodes of the network? I mean, maybe not in the sandbox, but do you envision that as this goes into commercial rollout, banks will be running these permission nodes of your blockchain network, and then NBFCs, and then fintechs, basically whatever the licensing regime allows, they'll be running these nodes in a way to sort of extend the network?
Yes, yes, that's what we envision. Because if just one party runs all the nodes, it doesn't achieve anything. So we want that there are external parties, specifically the banks, and we are not very sure about the NBFC. Maybe the larger NBFCs can do it, but some trusted parties can run these nodes, and the ecosystem can grow from there.
Also, I was thinking that do you have any investors on board? Have you sought funding for this? Are you bootstrapping this? Because I know this is a very it's a very tough problem to solve. I know a lot of people have tried to solve it. A lot of them have started off with the auto industry specifically, and I believe there are companies like C2FO who've partnered with say a Royal Enfield or some such to provide these kind of financing. I don't think that they really go down to tier 2. And because you mentioned that, a cost of financing like 18% or so may only be suited for entities that are upwards of 100 crores in revenue. I'm just thinking that these people, a lot of times, banks should be ready to fund, right? So, is it that um, they've maxed out on their working capital limits already with the banks, and they need an intermediary to kind of unlock through specific credit worthiness and get them financing? If that's true, then the TAM or the market size for this then goes even smaller for this thing. Then does it become investable, or would you eventually want a bank to see value in this and saying an NBFC saying that we could totally acquire Xaults, So just my investment banker brain going all over the place, and it'll be great to understand what your experience has been like while trying to raise capital for this.
Uh, so we do have investors. We did an angel round when we started in 23. When we formalized, we started in 22, but we formalized the company in 23. We have around 10 angel investors. We did this round in IIT Bombay. They do this 10-minute million thing. So we raised 31.5 lakh there. with that, we kind of created, the initial founding team. And after that, we started generating revenue for development enhancements of this DPT financing platform. With that money, we survived. We wanted to keep the team lean unless we have sufficient money. We didn't want to expand the team. So only with that money we survived. It's not that we didn't try to raise funds, but as you can see, there is a lot of regulatory uncertainty in what we are doing. Investors were kind of the opinion that they will look at us once the regulatory approval is there. So that has been the journey, and we are hopefully in next couple of months we'll get the regulator blessing, and
No,
move
absolutely.
forward. Yeah.
If you do, I think this is such a tough problem to solve. It's such an obvious problem to solve, but it's just not getting solved at the level that it is required in India, and I think it's probably people get spooked out because of the regulation, or the fact that they think a lot of it is being gate kept by banks, and it's really difficult to kind of come in. So yeah, I mean, kudos for really jumping into this, and you need a lot of passion to do this.
It's so ironic though, right? Like venture investors, their high conviction will come after all the regulatory approval is in.
Can you imagine?
Is a
I
is
think
a
I
little
think venture investing in India is such a joke, right? Like it's almost like private equity where you want safe bets. It's almost like they work like banks, saying we can't expect more than 80% of our portfolio going bust. With that mindset, they want a 20x return. It's almost like कि risk लेना नहीं है and reward Google alphabet level का चाहिए. So it's very crazy.
yeah, yeah.
True, true, and especially with companies working at the infrastructure level, it's anyway it's a tough play with investors.
Yeah, I think actually, so my question is going to be a bit more that there's two other sandboxes or two other, verticals that, for your love of all things regulators have taken on. And no, I mean this in a very flattering way, like I said at the start, right? Like you've really taken it on head on and not as we say, you're sort of chewing glass up front to get all of the hard work done that a lot of people will be beneficiaries of. So sort of salute to you for that. Two other efforts that you're running, one on tokenized, public equities and one on lines of credit. I wanted to also go through those. B, I also just wanted to get your perspective on what you think as an maybe as an outsider or as an observer of what's happening in the public blockchain space in the world. This like a complete 180 post the recent US election. You have Genius Act on stable coins, you have the Clarity Act coming up. Institutions have started issuing products on public networks now. And I just wanted to get your take on what do you think the trade-offs are, A, at a principal level, but then B, maybe from a market level and a market specific thing, like as much as you can share that you're seeing sort of happen in there. So those are broadly my questions. But
Aditya, see, a lot of inspiration of our work comes from the public blockchain space. Whatever we are trying to do, we have already seen that happening in the public blockchain space. And the seamlessness of finance which you can see on a public blockchain space, we are trying to bring that in the regulated markets for the consumers. But again, as the regulator comes, there are going to be certain frictions, but can we minimize those frictions? That's what we are essentially trying to do when we are bringing those models. On the SEBI side, we when we first met SEBI, and we were saying that this is possible. You don't need the clearing corporations because that can be managed by the contracts. You don't need clearing banks because money can be on chain, and you can make the entire system efficient. Um, and we learned that every market ecosystem player has a role to play, right? So maybe you cannot completely eliminate them, but you have to find workarounds where you can still improve efficiency and still keep those players, intact. And that took almost 6 7 months back and forth meeting with the regulators to eventually find out a model that will work, that they will approve. Okay, that this would work. You can bring in the innovation, but the regulator is also okay on taking certain risks that this new model can introduce. um, and it's not that we chose this path out of passion that we want to work with all the regulators in India. It's because the kind of products that we are working on, that's the only path to go, to go with. But over the time, we are kind of we have made peace with it that it takes time and it takes a lot of patience just to work with the regulator. And the regulator nowadays, I think it's pretty much open. Um, so same with SEBI, what we want to do is again tokenize the equities, lower the entry barriers for retail investors to invest in the equities market. A lot of people, would argue why not then mutual funds, why not ETFs? Those are already available, right? But imagine the level of customization you can get into once this is available, especially for the AMCs, right? The AMCs can create a, a lot more personalized products for their investors, right? So let's say I'm an investor, I want to buy Nifty 50, I need to have at least 40 lakhs rupees. But I can, with fractional shares, I can invest, maybe I can enter the market with just 4,000 and buy maybe 0.1% of the entire Nifty 50, right? What about if I want just my Nifty 48 because I already have exposure to Reliance and Tata, right? What if I just want top three shares, 5, 10, 15, it could be anything. And I can also decide on the ratio in which I want to, make my basket. So that level of customization is possible with this. You can do this via ETF route also, but doing ETF for every equity available in the stock market is going to take a lot of operational and also, you know, funds. Like it's heavy on both sides. But if it's available at the depository level, the market can just work seamlessly and all those customizations are possible. So that's what we want to achieve again with SEBI. Um, on the LC side, on the IFSCA side or the Gift City side, it's a similar model to what we are doing with the supply chain financing. Here we are tokenizing the payables of the anchor. There we will be tokenizing the letter of credit, and then again, instead of just the exporter getting the financing, we will open it up for the entire supply chain for the exporter, and then we will also, because this would be an asset class within the Gift City, we can enable foreign investing of from the HNIs and UHNIs of the issuer bank. So
Do you think that might happen first for you? Is it easier for the regulator to kind of approve that?
the Gift City one, the LC
Yeah.
tokenized.
Yeah.
Yes, because there is a similar platform which does this.
Oh, is it?
Yeah, in Gift City.
Okay.
So they do
Okay.
something similar. We are going a level beyond, and then I think also the instrument that we are chasing is going to change. They use invoices. We will be using the LCs. But I think Gift is little more advanced in terms of the being flexible towards this tokenization. They even launched a kind of a public paper for consultation. They were asking all the industries to kind of give their feedback. I'm sure Aditya knows for this. So they are I think pretty much flexible compared to other.
And they have, unlike the other regulators that have a lot of BAU that they need to run, I assume GIFT and IFSCA have a mandate to sort of bring in foreign investment into the country as well, into the special economic zone that they have there. And so it is in their interest. They're sort of set up to move a little bit faster, which is good to hear. I guess one of the questions I wanted to ask is, you know, there's a certain trade-off between a private and a public network, right? Um, there is a trade-off on, let's say, for example, on the liquidity that's available, on the market infrastructure that's available, right? You need to source all of this from scratch if you build your own private network. Whereas what we're seeing on public networks is that the liquidity and the market infrastructure sort of got organically built up over the years to do things that might have seemed trivial, right? So the same liquidity that was trading meme coins or launching NFTs, that same liquidity is now able to access quality assets, or the same AMM or swap or order book that was doing meme coin orders can now is already doing, in fact, tokenized public security orders in many markets, right? And so there's one, and then of course, but of course, like if you're a public network, you have less control compared to a private network, and you need to figure out if you can do security at the asset level, like we were talking about earlier, using something like token extensions. I'm sure every network has a version of this where you sort of find a way to build permissions within a public network as opposed to building a private network, right? A is one, and I think the second is also just opening up now with the Genius Act getting passed. You sort of have a soft or even a very explicit, messaging from the US that stable coins are equivalent to digital dollars, right? They're not sovereign money, but they're the next best thing. And so you sort of want your products to be able to access those and settle in those, which is that somebody, at least outside India with stable coins, should be able to buy that LC or buy that invoice within whatever FDI norms that India has. Right? So I'm curious to know what is your take on this trade-off and these sort of developments, and B, if you're able to share what the regulators take on any of these developments is, I think that would be pretty cool.
Sure, sure. No, see, one thing that we are trying to do is on the liquidity side, right? As you mentioned that if we are creating our own permissioned network, liquidity becomes a challenge, right? That's true if you want to create liquidity on chain. But the way we build products is they are compatible with the traditional, payment rails. So you can have your payments running on the traditional banking rails and the asset moving on our permissioned chain. And the lenders and the investors can, come from there. There might be a need, especially in the equities wala play, to maybe bring someone as a market maker. One of the AMCs can do that. But on the trade finance and the supply chain finance use case, I don't see liquidity as a problem. But that restricts um foreign investors to come and invest in this, right? If I just keep the asset very closely on that ecosystem. Uh, but because I already am on a blockchain ecosystem, it's easier to open it up to other ecosystems, right? Via interoperability rails. Those can be those possibilities are there. And that's what we are trying to do for the LC use case, where either on stable coins or deposit tokens can the foreign investors come and invest in the asset class, the LC asset class, which we are trying to create in the gift city. But for the domestic market, I think and it's purely my, how I read the regulator, nothing coming officially from them. The regulator doesn't want any alternate currency to work in the country, right? So the only currency issuer is going to be RBI there. You cannot have any other currency operating in the economy, right? So it might happen that we are still little far from stable coins being used as means of payment in the mainland. In gift city maybe yes, but in the mainland I see it's a little far. Why I'm
Sorry, but do
saying
you
it's a little
see?
far and not impossible, yeah.
So, I was just going to ask you on that. I totally agree that, under no paradigm is the regulator going to give up the domestic currency, right? I think people who believe that or argue for that is like complete non-starter, right? Like no sovereign country is going to
True.
give up its own issued currency. So I'm 100% with you on that. But do you think, like,
True. No, even for stable coins, I think we are a little far. We are a
yeah,
little
I mean,
far
but I would say
on
that
stable
there's a
coins or.
argument that you can treat stablecoins like you would dollars, right? Like the same way
Mhm.
within FEMA, you can send dollars to a bank account. The bank will custody those for you. You submit a purpose code and you get rupees. What if you could send stablecoins to your HDFC Bank account? HDFC Bank will manage them for you with RBI under a new framework, and you get rupees, right? So you at least open up connectivity to the new sort of dollar based, the new digital dollar based, economic activity that's going to happen without risking the dollarization of your market in any way, because you control the flows the same way you would for dollars. Of course, you cannot ban self custody in either scenario, but if you create a regulated framework for stablecoin payments to come in, then anybody who does not opt into that is very clearly breaking a rule, right? The problem today is that even for people who want to comply, there's no framework that they can sort
Mhm,
of
mhm.
opt into. So that was where I was coming from. But sorry, I interrupted you. Carry on.
Okay, got it. No, no, no. Thank you. I didn't think of it how you mentioned. So I was thinking about stable coins being issued pegged on rupee. So I think we are far from that right now.
Yeah,
But
yeah, yeah.
how you mentioned about the US denomination stable coins coming to India and the bank keeping custody of those, it's could be possible. So it's all how the regulator wants to do it. And I think if there is a demand from the industry, see, this is what I've observed. If there is a demand coming from the industry, the regulator definitely acts on it. The regulator is not going to keep blanket over all the things that the people are demanding, but the demands have to be coming from the regulated financial institutions. That's what the regulator wants, because it is not going to entertain to someone that the regulator cannot regulate, right? So there is but I think if the banks are willing to do it, if the banks see some merit, and there are definitely, when you move away from Swift and use these stablecoin rails, uh, the regulators should act on this. Maybe you should take this up. I think you are in the right position to do this. And if this opens up, I think it opens a lot of value to the overall ecosystem. So
Yeah, I mean, I am neither a institution nor regulated.
He's almost like the IAS officer for blockchain in India. So, which is why I think in pretty much all conversations, and I also think that he will do it for the entire ecosystem, for everyone in India, really. And that's what we're looking forward to, and hopefully, let's hope that really happens.
But honestly, I think it is like Neeraj said, it is like unless you have a product or a service to offer that is getting blocked, I don't think the regulator will or should listen to you, right? And so, for a lot of, if there's any like advocacy that the Solana ecosystem wants to do, can only happen through people who are building products in the space, and who first, like, the company has to see merit in using a public network in whatever way that they want to, and then you can sort of make the case there. I think that's where a lot of this is probably stuck right now.
no, true. Unless you can solve a problem, nobody is going to look at it.
Okay, so before we close, I have one question which is to both of you. As a non-techie, whenever you start talking private blockchain, public blockchain, and my first thought is that anyway, the problem statement that Neeraj has taken is like a very tough problem to solve. On top of it, he's kind of put it on the blockchain. So suddenly, in my mind, there are two hurdles to kind of overcome, and I don't mean hurdle from a regulator perspective. I mean hurdle from a just figuring out the tech or even explaining it to customers. Because I'm suddenly thinking of all the customers that I deal with in finance, and suddenly you tell them that we're going to put your data on the blockchain, they just be like, "What is this person even talking?" So, so now to educate the market about it is one thing. Second is, how do you even think of building a business on the blockchain in a country where the regulator does not acknowledge it as much today? Like Neeraj, I want to understand from you, like, how did you think, okay, I've got multiple ecosystems or platforms available, base layers on which I can build. Maybe I should go for a Solana, or I should go for an Ethereum, or I should go for whatever to build on. And then how do you even get the support to build it? So, did you at any point reach out to Aditya saying, "Listen, can you connect me to the right kind of people?" How did you guys even connect, or where have you found that support? Or you have some CTO, or you are the CTO who's like, "I'll figure this out and I'll build it on the blockchain." And people like me who are from finance are just like, "Hamara pura education is going to go down to waste because we don't understand this one aspect, which is the future of finance."
No, it's not like that, Satak. See, business will be built by people like you, right? Financial models will come from you. The technologies will keep changing, right? So even the regulator now understands blockchains. If CBDC, we talk about CBDC, it's running on RBI's, blockchain. So it's not that it requires a lot of knowledge sharing. Everyone understands on the surface, and that's what they need to understand, right? On the surface, that my data is going to be safe and it is secure. That's it, and I'm
Yeah.
going to reduce my cost or make some money out of it. If that premise is clear, nobody is going to dig down. If you just do your normal vapt and penetration
It's
testing.
like it's equal to putting it on AWS, and a business owner will be like, yeah, put
Yes,
it
yes.
wherever. I don't care as long as my data is safe.
You show your certificates that the system is secure. That's it. That's all the bodies ask. On the second question, which was around
How do you find the people to build on the blockchain or like,
right. So initially, when we started, we were lucky to find some good blockchain engineers, and it's not that we didn't assess all the frameworks which were available. So we assessed Ethereum, Hyperledger, Corda, Solana. But what we realized, and we might be wrong, we might be right, time will tell when we reach scale, uh, that for a particular use case, specifically for this deep tier supply chain financing, we don't want a general purpose blockchain. We want an application specific blockchain that is built just to do this, so that we can achieve highest efficiency which is possible to manage the scale at which we operate in India. And also we bring security at the protocol level and not still at the application layer. So you we keeping those two factors in mind, we decided that we are going to build our own blockchain, and that might someday become another popular layer one blockchain. So that's the idea. But let's see, long way to go still for us.
Aditya, do you have something on that? Like, because I keep asking you this question time and again, and I think it's because I didn't study engineering, I didn't study computer science, and even in today's day and age of vibe coding, I just keep thinking that is there a platform that helps vibe code on the blockchain, like quite like I can make websites on Love? Can I go say, Solana, please make me this thing, and it's making, and I'm just trusting and hoping that it's making whatever that the regulator will approve and it's safe, and where can I do that?
There's two or three things, right? One is that there's actually a pretty robust and growing developer ecosystem across all blockchains, right? Like, because this is one of those things where it's not about buying or trading or any of that, but uh, especially since a lot of this happened during COVID, when colleges were shut, schools were shut, people, everyone was just terminally online. There is at least a few thousand developers across various different ecosystems to build in India alone, and then across the world there's more. So there's actually a lot more. In fact, if you had to draw adoption curves for India on the developer layer, startup layer, and institutional layer, you'd be like, the developer layer is the highest. It's like there are developers from India who have gotten funded from abroad, like from investors overseas, and have they've then had to move out and sort of incorporated in other markets wherever it was more friendly to set up there. So at like the developer talent level, I think the market is far ahead. Um, then the next one is, can you vibe code this? Right? You actually can vibe code some of this stuff. Not very complicated stuff, though. I don't think you can vibe code a smart contract at this point, right? So if you need, or you should not, rather, because like that is really where the risk comes in of money getting lost or something getting hacked, right? But if you're using existing programs and you're building on top of it, like to a certain degree, you can actually vibe code a simple application and do some of that. Yeah, I
Yeah.
think for a lot of people, it might come from a place of, because of the internet, the world is smaller than ever. You can see what's happening in markets around you, and you can see, you in sort of markets where there is the freedom to build or it's not as restrictive. You can see the kind of things that are getting implemented, and then you take to something, right? So it's the same thing with AI. Even though it's not a regulatory problem, you would say that there's a lot more density of AI talent in, let's say, San Francisco, maybe in some parts of China. This is the AI race at the chip layer, at the for sure at the chip layer, and the model layer is playing out between the US and China, right? And the application layer can be anywhere. I think it's the same thing here. You can see that, you know, a lot of countries, and now the US, have sort of blessed this thing into existence. You can see applications being built by people just like you all over the world. You can see institutions in other parts of the world adopt this and hold it. And so that once you take to it, you sort of, that draws you in. And then few people out of those, literal sort of almost like missionary or champions, like Neeraj, will sort of come out and then try and take that to the regulator and sort of make the case. I think one of the beliefs is that it's always in some ways it's always product that precedes regulation, right? Like if you see how Uber and a lot of these things got licensed to operate in India, they just started operating, and then there was no framework, and then because people really liked them, used them, and they were perceived as a net positive, they sort of got regularized into the market, right? So I think it's like you see the pull of the technology, you see what can be built, and then you sort of go and start finding ways to work with the regulator. I think a lot of it is also you're forced to self-regulate, right? You're forced to be like, especially if you see the long-term potential of the industry, it is in your financial interest, apart from your reputational interest and just generally being the right way to do things. It's in your own interest to do things the right way, because if you don't blow up, if there are fewer scams, everyone is better off, and then you can expect the regulator to look at you more favorably, right? Take the simplest example of exchanges, right? The stock exchanges in India, there are so many rules. Like, you use a third party depository. You cannot hold customer funds for more than a quarter, right? Every quarter, your funds get deposited back to you. You cannot use customer funds for anything else. Like, you can't lend against them, or you can't do anything against customer stock. You can't lend against it. There's all these there's all these safeguards which are good, which exist. If you look at exchanges, because we've sort of demonized the asset class so much, Indian exchanges on the crypto side of things, they are their own custodians. They have to maintain their own proof of reserves. They have to show their own. They have like the full stack of compliance. The burden is just on them, and hats off to the ones that are doing it well. They're sort of taking on that burden until there's a framework, and until they can sort of pass this on to a few other folks. So I think it's first there's the pull of the technology. You see it happening in other places. You start doing it. You act, above and beyond. You sort of go above and beyond what a regulator could expect, and then you hope that you can sort of get it normalized if you prove in the market that there's enough demand for it. I think that's at least this is like from what I've seen from the founders who are doing it in any market. This is the approach that they're taking.
Yeah, so the parallel that I kind of draw from a skills perspective, because you say there are so many developers in India who can actually do this. It makes me think that Aditya, you and I, we went to the same batch at ISB, and I remember we had one elective on blockchain that I took, and I remember all of us had to kind of present a presentation on, okay, how do you apply this to some industry? And there were people talking about this applies to logistics and this applies to insurance. And I remember even we had done one project. I mean, I failed to even remember what industry we picked, but we presented and we got done from a marking or a GPA perspective. But because you know even at a B school, when you study finance, it does teach you a little bit about finance, and you can take that learning and you can apply it in the organization that you're at. Or maybe if you're learning product management or marketing, you can go and apply. I'm just thinking that, do IT colleges, computer science courses today in undergrad, do they really teach blockchain, or most people today are just learning about this online, quite like how startup finance is never a subject? And when I go and teach that at ISB now, I'm essentially telling them things and hoping that no finance professor walks in, because he'll realize what I am talking is nowhere in a book, and it's all like, just dilute 20% or whatever money you need for 2 years, five times of that is your valuation. And something like that, if a traditional finance person were to hear, they'll just think it's absolutely ridiculous. But that's exactly how,
How it
real life
works.
works. But you
Yeah,
wouldn't find a book which would
true,
say
true,
such a
true.
thing. So are like institutes teaching blockchain where even I can learn? Because both of you are so exposed to the system. Um, you would think, oh yeah, there are so many developers, but someone who's not a techie is almost always thinking that it's a new thing to climb. Even for finance, to me, to get to my qualification has taken 10 years before I started understanding what's really happening.
I feel like how there are those programs in entrepreneurship. No offense to any of the programs, but it's like it is a bit of a paradox to have a program in entrepreneurship, right? It's like entrepreneurship is only something you learn by doing to some extent. I think with any sort of cutting edge or anything frontier, anything that's new, you can only learn by practicing, right? Because so there are I'm sure there are certifications, because wherever there is demand, there's always supply of those certifications. But anything practical, you only learn through doing. I mean, in fact, when Neeraj and I were talking before this, he told me they had evaluated Solana 2 years ago, and I was just like, like the state of that ecosystem 2 years ago versus now is just like completely different, right? And so even for people who are practicing day to day, you would probably not know half of the things that are happening. So the only way to sort of participate in this is by finding your interest and your niche and then building up skills there, which is also why I generally, if my friends ask me how they should get involved, I don't recommend anyone to go buy something to go buy something, right? Like, because people want to go buy a token or trade something, like it's the worst possible way to start, versus taking the time to find the project, get involved on nights and weekends, give it some time, and then build up some skill, before you think about investing, which also becomes harder because you sort of stifle the growth of the industry in the country, and so there are fewer opportunities for that to happen. But yeah, that was my take on. I don't think, even if there is a course, I don't think you should do it right now, unless it's like a very practitioners practicing led course where you're getting to test your skills on live production applications with something, or in like a regulated sandbox, which is again, you have some information there that others don't, right? And you're learning something new or discovering something new as you go. General purpose certifications, I would say, I don't think they're very useful. I don't know, Neeraj, what do you think?
Yeah, so, I mean, I've learned it the hard way. So I was, my background is in technology transformation, so I understand technology a bit, but I was not a coder as per. And I thought the best way to learn blockchain is to start coding, and then later I realized that if I could have just understand the fundamentals better, I would have been, at the same level where I am right now. See, what I think is fundamentally you need to ask questions whether this technology can solve a problem for you. Right? It's always product first. And in most of the cases, I've seen people implementing blockchain is an overkill. Right? They just implement blockchain for the sake of blockchain, not solving for anything. Unless you are in a distributed kind of setup where you need, trust to be built without intermediaries, or you want some sort of, data protection, those kind of enhanced security in a distributed environment, you shouldn't actually use blockchain. You're just going to complicate unnecessarily your systems. So if you just understand the technology at a fundamental level, that this is what it is going to bring to you in the product, and if that fits, you should use it. Otherwise, you should just let it be. You don't have to start coding blockchain. You just need to understand what fundamentally it can do. That's what I would say.
Thank you, guys. Thank you. This has been very helpful. And Aditya told me before we started recording that this conversation, Sarthak, you'll specially enjoy because all my questions are around, oh man, the regulator doesn't approve this, or how do you take care of regulation in India? And thankfully, Neeraj is taking that problem head on and is doing so much good work for the entire ecosystem. So, from both of us and from everyone who's watching this, Neeraj, we wish you the best of luck. We wish you
Thank you
all the
so much.
best because you're
Thank you
doing
so much.
amazing work, and we really hope you get to commercialization of this super soon, and you get all the investor and regulator support, and this takes off and it helps everyone. Thank you, guys.
Thank you so much. Thank you for
Thank you.
having me.
Thanks, Neeraj.